Welcome to Cotality's Housing Market Update for October 2025, brought to you by onthehouse.com.au. The Australian property market is gathering strength as we head further into spring, with September marking the strongest monthly gain for national dwelling values since October of 2023. Our national index was up 0.8% in September, led by a 0.9% increase across the capital cities. On a quarterly basis, values were 2.2% higher, up from a 1.5% lift in the June quarter and double the 1.1% increase seen over the 3 months to March. In dollar terms, the September quarter rise was equivalent to just over $18,000 being added to the median value. Growth has once again become broad-based, with every capital city and rest of state region recording an increase in dwelling values over the month, over the quarter, and over the most recent 12-month period. That being said, some divergence in the pace of growth is once again starting to emerge. Perth and Brisbane are once again pulling ahead of the larger capitals, with values up 4% and 3.5% respectively through the September quarter, with the pace of gains being led by the unit market. Darwin is showing an even stronger run of growth, with housing values jumping 5.9% over the past 3 months. Each of these cities continues to show a severe lack of advertised supply. The number of homes for sale at the end of September was about 53% lower than average in Darwin, 45% below average in Perth, and down 31% in Brisbane. At the same time, estimates for quarterly home sales are tracking at above average levels, demonstrating a clear disconnect between supply and demand. Home values have risen across each of the broad value tiers. However, the strongest pace of growth has rippled from the lower quartile of the market to the broad middle of the market. This is likely a reflection of increased borrowing capacity, thanks to lower interest rates, which in turn could be supporting demand at slightly higher price points. Across the combined capitals, lower quartile dwelling values were up 2.6% through the September quarter, compared with a 2.7% rise across the broad middle of the market and a 1.8% increase in upper quartile values. Moving our focus to rental markets, the national vacancy rate slipped to a new record low in September, with only 1.2% of Australian units and 1.7% of houses estimated to be vacant and available for lease in September. The renewed downtrend in rental vacancies has been accompanied by a re-acceleration in rental growth. Cotality's national rental index rose 0.5% in seasonally adjusted terms through September, taking the quarterly change to 1.4%, the highest since June last year. The bad news for renters, of course, is that rental listings are continuing to trend lower, tracking about 25% below the 5-year average in September. Adelaide home values were up 0.9% in September, in line with the combined capitals benchmark, which was also up 0.9% over the month. The September update takes the quarterly growth rate to 2.5%, the highest 3-month change since November last year. Advertised stock levels remain extremely low across the city, tracking 36% below the 5-year average for this time of the year and 15% lower than a year ago. The lower quartile of the value range is continuing to drive the strongest gains, with values up 3.3% in the September quarter, compared with a 1.7% rise in values across the upper quartile of the market. The spring selling season is shaping up to be a strong one, with vendors definitely back in the driver's seat. Low advertised stock levels and higher buyer demand are a recipe for solid selling conditions that will likely see prices lift further through the rest of spring and into the end of the year. The 75 basis point cut to the cash rate has played a key role in supporting housing activity. Borrowing capacity, based on a median household income of $106,000, has increased by about 7% since the first rate cut in February, and lower interest rates have supported a lift in consumer sentiment, which is really important for high commitment decision making. Despite a minor slip in September, the monthly consumer sentiment index is 12.8% higher than a year ago, with the upswing in confidence being accompanied by a rise in purchasing activity. Real wages growth is adding to sentiment and to savings. At 1.3% per annum, inflation-adjusted wages growth was at its highest level since June of 2020, and it's about 2.5 times the pre-COVID decade average of just 0.5% per annum. Stronger wages growth alongside lower debt servicing costs should help to further support purchasing activity and sentiment. A tight jobs market is another factor supporting demand and borrowing capacity. The unemployment rate held at 4.2% in August, and the underemployment rate at 5.7% hasn't been this low since 1991. Although labour markets are expected to loosen a little, the low unemployment rate and real income growth should add to support for housing demand and higher prices. With the expanded home deposit guarantee going live on the 1st of October, The opportunity to get into the market early with as little as a 5% deposit and without the added cost of lender's mortgage insurance is likely to be popular with prospective first home buyers. We expect to see high levels of demand concentrated around the new price caps in the coming months. We could see the value of houses in well-located areas, recently unlocked by the expanded caps, surpass the new price caps quite rapidly. As at the end of September, 50% of Australian suburbs had a median house value that was at or under the new price caps, and 93% of suburbs had a median unit value at or under the new price caps. Although the outlook for housing markets is looking increasingly positive, some headwinds remain that will likely keep the rate of growth in check. Stretched affordability is arguably the most significant factor keeping a lid on value growth. Based on data to June, the median national dwelling value to household income ratio was only marginally off record highs at 7.9, with Sydney recording a ratio as high as 9.6. We also have some renewed uncertainty around the path of inflation, given a higher than expected monthly inflation indicator reading for August, which could push back the timing and extent of further interest rate cuts. There's plenty to keep an eye on as we move through spring. You can keep up to date with all our property sector analysis at the Insights pages of the Cotality website.